Howdy, Jacob here. Today we're looking at Gildan Activewear in the textile apparel and luxury goods industry. 5.9 billion market cap, half a billion higher enterprise value. Growth has been relatively slow, 2.4 billion in 2014 to 3.2 billion in 2023. Return on invested capital, however, has been consistently mid-teens, which is fairly impressive. But again, if you look at their use of cash, if it is repurchasing shares, that can inflate your return on invested capital figure. Their dividend has been growing pretty substantially as well. Earnings per share over doubling over the last 10 years. So I like that their earnings per share are growing well over their revenue, with margins relatively similar on the gross margin side and slightly higher on the operating margin side. Their balance sheet shows 90 million cash on hand with 685 million short-term debt, 300 million long-term debt. So just under a billion short-term and long-term debt on 90 million cash. As of now, I'm a little bit concerned about that, but let's look at the cash flow statement and see what type of cash they produce. So we see that on a 5-year average basis, we're probably looking around 350, $400 million. And so let's be conservative, 350 in comparison to a billion is less than 3 years. So less than 3 years, their 5-year average free cash flow to pay off that debt is not super concerning. I wouldn't say that this is the prettiest balance sheet I've ever seen, but I will say that I'm not super concerned with that, especially in the fact of, although they only have 90 million cash on hand, they have the capability of either refinancing that 300 million, that short-term debt, or paying it off with a year's worth of free cash flow, which again is not ideal because if they have a cheap stock or they have things to invest in that might not be most advantageous to them. But I think that I'm definitely not concerned with that balance sheet. That I would be very surprised if they went under due to the fact that they've historically made a good amount of money from cash from operations and free cash flow to where they could pay off that debt. But use of cash is pretty light on acquisitions. It looks like at the beginning of mid 2010s, they were buying back a good amount in acquisitions, but recently their dividend of 2.3% is paying out roughly 35 to 40% of their 5-year average free cash flow, with about 70% to share repurchases. And so it looks like they actually issued a little debt to buy back even more shares in 2022. Let's just see in 2022 where that stock was. So, I mean, if they bought it over here on 27, that might be a decent buy. Obviously, we're going to do our stock analysis later to see what we think it's worth. But if they were going into debt to repurchase shares at this 40, that might not have been the best return. So we're going to do that analysis shortly to see whether that was a good time to buy or not. But it looks like use of cash seems pretty fine to me. Not a whole lot of reinvestment. There's actually lower capital expenditures now than there was 10 years ago. So we can't really give them a premium for this high return on invested capital in the mid-teens due to the fact that they're not reinvesting at those types of rates. And so if you have the 15, 20+% return on invested capital and you're reinvesting back in yourselves, you definitely want a premium on both increased margins, increased P at the end of the 10 years or 7 years, whatever we're looking at, because they're really good at reinvesting back in themselves to expand that rate of return exponentially. Whereas here, they're not really reinvesting it; they're just buying back shares and paying out a dividend. And so, to me, I don't see any reason for an excess premium here. So let's go to our assumptions on the revenue side. Probably pretty small, probably maybe 3%. I'll give them a 14p due to the fact that if they do reinvest, they do have that possibility of getting a good rate of return on it. But historically, we haven't seen them really reinvesting in themselves to deserve a higher premium than that, from my perspective. And then the margin side, let's do 12, 13, and then repurchasing of shares they've been doing a lot of recently. It's about $6 billion. So 4% would be about $240 million, which, I mean, they've done not a whole lot of stock-based compensation. So we're looking at about 270 million share repurchases, which is a good amount of their free cash flow. You're looking at maybe 70 to 75% of their free cash flow, but I think I'm fairly comfortable with that. And then on the dividend side, they've been increasing it quite a bit, but I'm going to increase it. They've actually been increasing their dividend quite a bit more than their share repurchases. So maybe I'll do 3% there. And on the dividend side, let's increase that to 8%. And so my logic for that was again, I have to balance out what I want the company to be doing with what I think with what I've seen them done historically. And so they can afford a 4% share repurchases, which is about 300 million, but that is going to be about 80% of their free cash flow. And so if they only increase their revenue and margins, or they increasing their operating margin and free cash flow at 3, 4, 5%, then if I were to increase their dividend at 10%, it's going to get to a point where they're paying out over 100% of their free cash flow with none left over for acquisition and reinvestment or debt repurchases. And so what I did there is I lowered the share change to 3%, saying that it's going to be more along the lines of maybe a little over 200 million, 210, 220 maybe million in share repurchases. And then their dividends are going to be maybe in the 150 range. And then that leaves maybe 20% of their free cash flow, 10 to 20% of their free cash flow to buy back companies through acquisitions that hopefully are advantageous to making the company more efficient, not just increasing revenue, buying down debt if they need to, or reinvesting back in themselves if they find opportunities with these mid-teens returns. And we get to a price that needs to fall 35% before you get the return that we're looking for. So if they were repurchasing shares at 40, to me that seems like not the most advantageous use of money. But if they were repurchasing it at $26 a share, that could be a fair return on the money. I mean, 26 is 12%, 12 to 13% given my assumptions here. And so maybe, 2 years ago, that would have been not too bad of a return, 10+% at least, maybe. But, the business knows the business is not always the most advantageous with their capital allocation. So just keep that in mind. Sometimes I've seen plenty of companies buy back 7, 8, 9% of shares when it was the frothiest, just because that was when their business was performing the best. And so you don't just look at share repurchases and say, oh, it's great, they're giving me a 6% return because there's 6% less shareholders. The return is what the stock price does and what their company actually performs at. And if they don't perform great and they get you a 5 to 6% return, buying back those shares at that price does not make a whole lot of sense. But me right now, I think I'm just waiting 35% drop before it gets to the return I'm looking for. So I'll just be waiting to do further analysis. But hopefully you enjoyed the video. Have a great rest of your day. Thank you.